All right. Good evening to you all. My name is James from Varsity Unlimited Tutors. I sent through a message yesterday in one of your groups that I'm going to be doing accounting and financial management lessons. So, what I'm going to do for tonight is for about 5 minutes of your time, I'm going to explain the service that I offer. And then for the remaining 55 minutes, we are going to do an example of a financial management exam question, just to give you a little bit of a background of how you handle particular questions. And this will be useful to you when you're handling your assignments, when you're handling your exams, and also just give you a little bit of a sneak peek into how I offer my services in order for you to make any choice that you might need to make. Right. So, Varsity Unlimited Tutors is just basically an organization of different tutors who help students out with their assignments, who help students out with their exam preparations, who help students out with study materials. So that's basically what we do. Right. So each and every semester, we have certain modules that we take up and that we can tutor students for. All right. So for you guys, you have got three assessments that you need to worry about. You've got your case study assessment, you've got your project assessment, and then you've got your online summative exam assessment. So the way that we assess students is we can take you through the case study assessments question by question, breaking down the question in terms of what do you need to do in order for you to get the best marks possible on each particular question. And then we go through past exam papers and provide videos of previous past papers where we go through the questions that were done in those previous years in order to help you to understand how to pass how to pass your exams. So that's basically what we do in brief. All right. Then just a reminder, your assignment, I believe the first due date for your assignment is going to be 17 February. I believe that's the first due date for your assignment, depending on which degree that you're doing. It's just something that you to remind you. All right. Then what we charge, because remember, like I posted in the group, I do charge for this service, although I will offer one or two free classes so that you know who you're speaking to. But at the end of the day, if you want us to go through the exam preparation with you, if you want us to go through the assignment coaching with you, there are certain charges that are applicable, as you can see on the screen. We can talk about them in detail, maybe after the lecture is done, with those of you that are interested in pursuing or in continuing with the lesson. So there's a timetable that I'll make available for those that want to be part of the lessons. But we are starting on Thursday, 23 January, up until we get to mid-March. So that's when we'll be doing the assignments, right? So for the next 2 weeks, we'll be doing the case studies, and then for the other 2 weeks, that is end of February and early March, we'll be doing the projects, right, at the specified dates. Right? So for each assignment, we dedicate between 2 to 4 hours of lectures. Between 2 to 4 hours of lectures, we meet, we go through a particular question together. The students ask questions. We explain how to break down the question, how to get more marks out of the question, what you need to include, how you do your referencing, and etc. And then the students will go and then write their own assignment. So we are not doing the assignment for you. You do your own assignment, but we provide you with detailed guidelines in terms of how to do that particular assignment, so that at the end of the day, you are guaranteed to get your distinction, you're guaranteed to get a very good mark from that particular assignment, right? So this information is available for those that are interested. You can always text me. I'll provide you the timetables for each particular module. So for MBA, we do all four modules, which is HRD, Financial Management, Quant, and Corporate Strategy. For postgraduate diploma in business management, we do 5 modules, which is HRD, Accounting and Financial Management, Strategic Management, Advanced Project Management, and Economics for Managers. Unfortunately, we do not have lessons for business ethics. We do not have lessons for entrepreneurial dynamics, but we do these 5 modules here. Then for honors, we do both of the modules, which is operations and accounting and financial management, right? So, and then for postgraduate diploma in project management, we do all 4 modules, which is stakeholder, project financial, project quality, but we do not have lessons for project applied technology. However, for those of you that are stuck on the assignment for project applied technology, we do have an alternative, although it is not necessarily lessons that we provide for this one, because it's a very practical module. It's very difficult to host the lessons for project applied technology. All right, so that's basically just a short description of what we do or what we offer as Varsity Unlimited Tutors. So if you check in the chat box, I have sent through a sample past exam paper question and a sample answer, which we are going to go through in a minute or two right now. So just check on the platform there, on the chat platform. I sent through a question paper and an answer, which I'm just going to go through and explain, right? So in each and every semester, your lecturer provides 2 assignments and an exam. And for each and every semester, we have been assisting students, right, with the preparation for those exams and with guidelines for those assignments, right? So I do have videos and solutions for each and every assignment and each and every exam for the past, I think, 3 to 4 years that I have in my database. So that's one of the benefits for the students that are going to be joining through the classes that we host, that if you want those access to those videos, if you want access to those solutions in order for you to better prepare yourself for the exam, they will be made available to you. Right. So I'm going to take here one of the past, this is from last semester, 2024 July, one of the assignments. There was a question on capital budgeting. I believe I looked at project financial management, accounting and financial management, and MBA financial management. All of you guys do capital budgeting or investment appraisal, which means it's a topic that all of you do. So that is why I picked up this example, because it applies to all of you. So we are going to go through the example together, and I'll explain as we go through the example how you conduct capital budgeting or investment appraisal within your organization, or when you're tackling an exam question, and hopefully that will be useful and helpful to you as a student, i.e. in terms of tackling any other questions that you might face that require you to do capital budgeting, or when you're in your own workplace, right? So I hope you had a chance to just download the message that I sent, right? So there was a question here. The question, we've got an organization called Springbok Limited. So just for a minute, I'll just read through the information so that you can catch up on me before we start talking about how to address a particular question such as this one. Right. So Springbok Limited is expanding its operations and increasing its market share in the cell phone industry. To achieve this, they are looking to increase the current productive capacity to 1 million cell phones a year by at least 6% for each of the next 5 years. It is considering 2 cell phone making machines and is unsure which one to purchase. Right. So the organization wants to increase the capacity of their organization or the capacity of their manufacturing by 1 million. So they want to manufacture, they are currently manufacturing 1 million, but they want to increase their capacity by at least 6%. That is the idea. That is what they want. Now, in order for them to do this, they have got options, right? They can buy either machine ABC, or they can buy machine XYZ. So these machines are cell phone manufacturing machines, right? So if they buy machine ABC, they are going to spend 1,600,000 to buy the machine, and then 400,000 to transport and install the machine within the organization. Right? Once they've installed this machine, it can be used for about 5 years. And when it is being used, we expect that this machine will give us a net cash flow. That is an important term when you're doing capital budgeting. A net cash flow of 440,000, 560,000, 800,000, 820,000, 400,000 over the next 5 years. So that's what we expect. And this machine alone increases the capacity to 4%. Remember, they want to increase capacity up to 6%, and this machine only gives them 4%. Now, they have a second option. They can go for machine number 2. Machine number 2, which is XYZ, it can be bought locally for 2 million. There is no installation cost, there are no transport costs, it is just 2 million. And it can be used over 5 years. Now, if they use this machine over 5 years, it is going to give them net cash inflows of 600,000 every year. So that's the money that they are going to receive from whatever they are going to be selling. And it only increases the productive capacity by 2%. The other one by 4%, the other one by 2%. Right. And then we are told some extra information. We are given the return on capital, which is 15%. We are given the depreciation policy of the organization. And then we are given that the organization has got 4 million rand. And then the question that you are then asked now is, with this 4 million rand, should this organization authorize the purchase of these 2 machines, right? And then you're given certain conditions. For example, one of the conditions is that the organization only accepts a payback period of 4 years. Right. So this is a typical decision that you can find within an organization that you have to make. You've got a large amount of money and you have to decide how to invest that money within an organization. In order for you to do that, there is a subject called investment appraisal or capital budgeting. Investment appraisal or capital budgeting is whereby you take money that you have as an organization and you assess the different projects that are available to the organization in terms of whether they are a good investment for you or they are not a good investment for you as an organization. It helps you to choose between different projects, whereby whether you want to rank a project or whether you want to know whether it is worthwhile for you to invest money within that particular project. So that's one of the benefits of learning financial management as a manager. It means you can make proper decision using a cost-benefit analysis approach to decision making, right? So in order for you to tackle a question such as this in the exam or in real life, you need to understand certain particular things. So in my notes over here, which I sent through on the platform, is I said that number 1, you need to understand what theory applies to this, which I've explained that this is called capital budgeting or investment appraisal, which means if you're doing an assignment, you then go into your study module and you look for the unit which is what? Which is capital budgeting or which is investment appraisal, and you read up on that before you answer the question so that you can use the correct methods, right? Then step number 2, understand all the different methods that are available for you to tackle this question, right? So when you're doing investment appraisal or when you're doing capital budgeting, there are different methods of assessing whether to invest in machine ABC or in machine XYZ or both, right? So just for a list of the method, but you can get this in your study guide. I don't think it's something that we can focus too much of our energies on. You can get it in your study guide, but there's what is called the payback period. We'll explain this as we go. There's what is called the payback period. There's what is called the accounting rate of return, right? There's what is called the net present value analysis. There's what is called the internal rate of return analysis. There's what is called the profitability index, right? There's what is called the discounted payback. So there are so many different methods that you can learn in terms of what you can use for this. But the most common methods that you need to learn as a student is the payback period, the accounting rate of return, the net present value, and the internal rate of return. These 4. These are usually the critical ones when it comes to assignments, when it comes to exams, and etc., that you are expected to know, right? So once you have identified, because remember, he said that choose. So it means you need to choose which ones of these are you going to use. You'll find that in this assignment, I used, I think, about 5 different methods. But the reason I did so is so that you learn. But otherwise, in an assignment or exam situation, using 2 or 3 methods will be more than enough, right? So then the third step I then said here, understand and calculate the different cash flows or net profits or information required in order for you to answer the question. So when you are calculating the payback period, when you are calculating the accounting rate of return, when you are calculating the net present value, there is certain information that you need. And this information is called the cash flows or the profits that the organization is going to to have. So there is the initial cash flow, there is the net annual cash flows, there is the terminal cash flow, there is the investment, right, that you are going to have to make. So those are the different cash flows that you need to understand for you to be able to do that. I'm not going to go deep into this because of our time, but we'll do some of the stuff as we go. Right. Then number 4, perform the calculations. Once you know what the cash flows are, you then perform the calculations. And then number 5, you interpret the findings. So it means that if you calculate the payback and you get a payback of 3 on machine XYZ and a payback of 4 on machine ABC, what does that mean? You need to interpret the findings of what you're talking about. So those are the steps that you need to conduct. So we are going to do that now as we go through. I believe we're still very good in terms of our time management. Yeah, we still have 40 minutes, right? So let's go through a part of the steps that I was talking about. Unless if there's a question before I now go through the steps one by one. No question. That's wonderful. All right. So I highlighted that you need to understand the cash flows. Right. Step number 1, step number 2, straightforward. We've done that. But step number 3, understand and calculate the different cash flows. Right. So whenever you do these questions, right, let me put it this way here as part of the notes. When you are doing payback period, you are going to need to use what is called net cash flows whenever you are doing payback period. When you are doing accounting rate of return, you need to use what is called net profit, right? When you're doing NPV analysis, net present value analysis, you use net cash flows, right? When you're doing internal rate of return, you use net cash flows. When you're doing profitability index, you use present values. When you're doing discounted payback, you use present values. Right. So which means that before you start any of these things, you need to be able to identify, do I have the net cash flows? Do I have the net profits? Do I need to calculate these things before I even start? So that when you start your calculations, it becomes easier for you. So you'll find that when I was answering this question, the first thing that I did is I had a subheading where I highlighted that these are the net cash flows and these are the net profits for each and every one of these projects. So for example, I took project ABC and then I highlighted in year number 1, year number 2, year number 3, year number 4, year number 5, what were the net cash flows in each and every year. Right. So for example, for ABC, if you go back to ABC, I'm just going to highlight over here so that you see where I took that from, right? You see 440, 560, 800, 820, 400. So those are my net cash flows because the lecturer told me here that that's the what? That's the net cash flows. But if I check on the question, the lecturer says nothing about the net profit. But I want at a later stage to calculate this thing. I want to calculate the accounting rate of return. So I need to be able to convert net cash flows into net profits, right? For me to calculate the accounting rate of return, I need to be able to convert net cash flows into net profits. Because if I look at the question, I have not been provided with the net profits, only the net cash flow. So those are some of the tricks that the lecturer will put in order for you to end up messing up on the question. So what do I do? So for me to get a net profit, right, I am going to say the net cash flow minus the depreciation. That's what I'm going to do. I'm going to say the net cash flow, which is the net money received every year, minus the depreciation, right, charged for the product, right? So the next question that you're going to ask me, for those that have done accounting, is straightforward. You know how to calculate depreciation. But if you've never done accounting, the next thing that you're going to ask me is, James, what is depreciation, number 1? And then how do I calculate depreciation, Right. So depreciation is just a capital charge or usage. So for example, if you have a vehicle, if you use your vehicle for the next 5 years, it loses value as you are using the vehicle. So that's what we mean when we say depreciation. We're saying the loss of value in the machine or in the asset as it is being used on a day-to-day basis. So how do I calculate depreciation? For you to calculate depreciation, you are going to say the initial investment in the asset minus what is called the scrap value or the disposal value of the asset. All of that is divided by the useful life. Divided by the useful life of the what? Of the asset. So that's how you calculate depreciation. So depreciation for our asset here, ABC. So what is our initial investment of ABC? We invested 1.6 million plus 400,000, right? The purchase cost and the transport cost, the installation cost. So which means our initial cost for ABC is going to be what? 2 million. That's our initial cost there, right? And what is our scrap value? If we look at the question there, I do not think we have a scrap value. Let's see. Yeah, you see this word here? After 5 years, the machine cannot be sold, which means that it has no value after 5 years. So our scrap value is going to be 0. In some questions, it will not be 0. That's why it's there, right? Divided by the useful life, which is 5 years. If I do that, I'm going to get 400,000 in terms of my depreciation. So that is why you see this little table where I have indicated the net cash flow, I've indicated the depreciation. Remember the formula for profit? We said it's what? It's net cash flow, which is 440,000 minus depreciation, which is 400,000, which gives me 40,000. So which means that for my machine ABC, I now have got all of the net cash flows for each year. I now have all of the net profits for each year, which means that I can estimate payback period, I can estimate accounting rate of return, I can estimate NPV, I can estimate IRR because I have that information. I can do all 4 methods here. Right. So I did the same thing also for machine XYZ. Right. I calculated the depreciation, which was 2 million minus 0 divided by 5 years, which was 400,000. I listed the net cash flow for each year, which I was given by the lecturer. Over here, 600,000 per annum over 5 years. So that is why you see 600 there. That is why you see 400 there. So 600 minus 400, 200 for each and every year until we get to the end. So which means I am done with step number 3, which is understanding the cash flows of the project. Additional cash flows that I have over here that I can write about if I want to is I can indicate that for machine ABC, my initial investment is what? 2 million, which is what? 1.6 plus 400,000, right? And then machine XYZ is also initial investment is also 2 million. So that ends my chapter in terms of what? Understanding the cash flows of the project, right? This project does not have terminal cash flows because both of the projects do not have a disposal value. But there are some projects that have a disposal value, which means they've got what we call a terminal cash flow, which you might need to factor in. So I'm now going to go into the next stage, which is actually calculating the payback, actually calculating the accounting rate of return, the NPV, the IRR, etc. So that becomes my next stage. All right, someone says here, where did we get the 2 million for ABC? We added 1.6 million in 400,000. We added the purchase cost and the transportation and installation cost. Transportation and installation cost, customs duty, all of those things form part of the initial investment. That is why we added them in there. Right, so I'm going to go to my next part. Right. So my next part now, I want to start with what is called the payback period. So what I'll do is I'll explain what payback period is, and then we do the calculation. So when we are doing investment appraisal, or when we are doing what is called capital budgeting, a payback period represents the time it takes a project to give us the money back. So remember, we invested 2 million into the project, and the project is going to be giving us money back each and every year. So how long does it take for us to get the 2 million back? That's payback period. If it takes us 5 years, then our payback period is 5 years. If the other machine takes us 2 years, then it means the other machine takes shorter. So just think of it, you are an investor and you're given two options. One option, in 2 years' time, you have all of your money back. The other option, in 10 years' time, you have your money back. Which option do you take? You prefer the option which is shorter in terms of the payback period. So that's the idea with the payback period. You want something with a shorter payback period. So let's start with machine A. How do we calculate the payback period of machine A? Right. So please follow me here. I know the answer is already there, but please follow me. And if you don't understand, ask so that you don't lose yourself. Right. So what is the investment? So we invested 2 million. Right. So if I put a figure in brackets like that, I am saying it is negative. That's what I am saying. Right? If I put a figure in brackets like that, I am saying that figure is negative. So we invested or we lost 2 million in order for us to get this machine. Then in year number 1, remember, when we are doing payback, we use net cash flow. This is very, very important. We use net cash flow when we're doing payback period, right? So in year number 1, what is our net cash flow? We are told by the lecturer we receive 440,000. So the question is, have we paid back in full the money? And the answer is no, we have not paid back the money. So it means our payback is not 1 year. Right. So how much money is left that has not yet been paid back? So minus 2 million plus 400 gives us minus 560, right? Minus 2 million plus 440 gives us 1.560, right? At the end of year number 1. We go to year number 2. Year number 2, how much money did we receive in year number 2? 560,000. That's what the lecturer says there. 560,000. Have we fully paid back? No, we have not yet fully paid back. Right. So again, we check what was the balance from year number 1? Negative 1,560. That was the balance, right? Plus, how much money did we receive? 560,000. And that gives us what? 1 million balance. So which means we are left with 1 million. We go to year number 3. These are workings over here. You don't need to include them when you are doing your presentation. They're just workings, right? And then we go to year number 3. How much money did we receive in year number 3? 800,000. Did we pay back? No, we have not yet paid back. How much money is left? 1 million plus 800,000. And then we get what? Negative 200,000 money left that has not yet been what? That has not yet been paid back. And then we go to year number 4. Guess what? We get 820,000 in year number 4. Remember, our balance in year number 3 was negative 200, but now we are getting 800. So which means we actually pay back in year number 4. So if we were to answer this in general terms, we would say our payback period is 4 years. But that's actually not true. Why am I saying it's not true? Because it does not take the whole year number 4 to pay back this project. Remember, we were owing 200,000 at the end of year 3, and we received 820, which means somewhere along the year, we fully paid back. Your lecturer wants your answer to be specific. He wants the number of years, he wants the number of months, he wants the number of days. So how do you do that? So which means the number of years there, it becomes 3 years plus certain number of months in year number 4. So we are going to say it took us 3 years, which is the 3 years that you see there. And how do we calculate the months left? So what we do is we take the balance. We take the, let's put a formula there. We take the balance from the previous year, right? And then we divide that by the incoming cash flow. Right? And then we multiply by the number of months in a year. Right? So what was our balance? Our balance was 200,000. And what was the incoming money that we received? 820,000. And how many months are in a year? 12 months in a year. So if you multiply that, you get 2,93 months. So which means our payback period is 2 years, 2 months, 93. This 93, we need to convert it into number of days. So we take the 93 and we multiply it by 30 days in a month. A month has 30 days, not 31. A month has 30 days. So we multiply it by 30 days and then we get 28 days as our final answer. So that's how we calculate the payback period. Questions? Wonderful. All right. So there are 2 methods of calculating payback period, actually. So I'm going to show you the second method. But the second method only applies if you are receiving money that is the same every year. Remember, project XYZ, the lecturer tells us that XYZ receives 600,000 every year. It does not change. It does not move to 700 and then to 800 and then to 500 or something like that. It continues to be the same amount each and every year. So if you are receiving the same amount each and every year, this is how you calculate payback period. You are going to say the initial investment divided by the net annual cash flow. That's going to be your payback period. Very simple. But it only applies if you are receiving the same amount. So we could not use this formula for ABC because ABC, it was 450 and then it was 560 and then it was 800 and then 820. You see, it was changing. So we could not use this formula. But for project XYZ, it's very straightforward. We can use this formula for project XYZ. So let's do that. Right. So payback XYZ is equals to initial investment, 2 million, remember, divided by net annual cash flow, 600,000. Put that in a calculator. I'm going to get 2 million divided by 600,000. That's going to give me is equals to 3.3333 years. That's my answer there. But remember, I said your lecturer is specific. He does not like this. He wants your answer to be specific. So which means my payback period is going to be 3 years plus how many months? I'm going to take the 0.33333, multiply it by 12 months in a year, and that's going to give me what? 4 months. Right? And that is why you see my answer there says payback period is 3 years, 4 months. I did use the same formula that we used above. Yeah, that's the same one I did. So you see it has the same conclusion, but it's just a shorter method. Why do we want it? Because it's, you don't have time in an exam sometimes. You want something that is very short and quick. So that's how you calculate the payback period. So now that we have the payback period for machine A and the payback period for machine B, now the question that we are going to ask ourselves is which should we choose? Now remember, the lecturer told us that only projects, I'm going to highlight it here, only projects with a payback period of less than 4 years should be accepted. Machine XYZ says what? 3 years, 4 months. Machine ABC says what? 3 years, 2 months, 28 days. So both of them are fine because they are less than the maximum payback period. So we can actually accept both projects. If you have to say which one is better, Of course, the one that says 3 years, 2 months, 28 days is better than the one that says 3 years and 4 months. But we can accept both because the decision rule, that's a very, very important term, decision rule. The decision rule, according to this organization, is anything less than 4 years in terms of payback period can be accepted. And remember, this organization has got 4 million rand. And these projects, both of them, if you add them together, they give you 4 million rand. So which means they can actually invest in both projects. So just using the payback period alone, you have actually answered this question. Of course, I would not recommend doing one method and submitting it, but in technical terms, you are done with the question just by what we've done so far. You are done with the question because you've answered the question using the payback period. Now we want to go to a different method, but before we do that, let's check if there are any questions. Are there any questions? If no questions, it's fine. So let's use the second method, right? So second method that I want to look at is accounting rate of return. That's the second method. Now, remember when I said payback, we were looking in terms of the number of years it takes for you to get your money back, right? Some investors, they are not interested in the number of years. They want to know the percentage return. What is the return on investment for this particular project? That's what they're interested in. Is it 15%? Maybe they want to compare. Maybe if they go to another company, they're being told that, okay, if you invest money into this company, you get 10%. If they go to FNB and they put in the fixed deposit, they get 5%. If they put in a money market share, they get this percent. So they want to know what is the percentage return for every rand that I have invested in the company. So you can do that using what is called the accounting rate of return. Now, the accounting rate of return, this one is a little bit tricky because there are different formulas for accounting rate of return. All right, there is what is called the accounting rate of return on average investment. And then there's what is called the accounting rate of return on initial investment. Please make sure you use the formula that is in your study guide because I know it's different. It could be different for the MBA students. It could be different for the postgraduate diploma students. It could be different for the project management student, but it's there in your study guide. So make sure that you use the formula provided by your lecturer in your study guide, right? So there is two. There is one that says on average investment, and there's one that says on initial investment. They're very straightforward. Don't worry about them. They're very straightforward. It's just that one of them you divide by the average investment, then the other one you divide by the initial investment. So I will do the one for the average investment, which is slightly more difficult, but the one for the initial investment is straightforward because you already know what the initial investment is going to be. Right. So accounting rate of return, when you are making a decision, the higher the accounting rate of return, it means the project is what? Is more profitable because you are measuring the profit you earn per every rand. So the higher the accounting rate of return, the better the project is. So how do you calculate it? The formula says average annual profit divided by average investment. If it's the other one, which is initial, it says average annual profit divided by the initial investment. But we are using the on average investment. That's why we are dividing by the average investment. So where do I get? Yeah, so let's add a little formula here. Where do I get the average annual profit? I'm sure now you start to understand why I did what I did initially. Remember those tables that we created when we started, where we were calculating net profit? That's the reason why we needed those tables. Because if you check here on the question paper, there is nothing about profit there, which means you need to calculate it by yourself. If you can't do it by yourself, it means you have lost marks on this question. So average annual profit is the total profit divided by the number of years. Right? So what is my total profit for machine ABC? So average annual profit ABC. Forgive me, I have to go back and forth. Average, so if I go there, what is my total profit for ABC? I have to add 40 plus 160 plus 400 plus 420 plus 0, and it gives me what? This figure here. That's my total profit for ABC. Is this correct? Yes. So that's my total profit for ABC here. So it's equals to that divided by 5 years, right? So that's going to give me 204 as my average annual profit for ABC. What about my average annual profit for XYZ? XYZ. My total profit for XYZ, it was 1 million divided by 5 years. And that is going to give me what? 200,000 as my average annual profit. So now I have the average annual profit. Now I want to know what is the average investment. How do I calculate the average investment? So average investment, the formula, is going to be equals to the initial investment plus the scrap value divided by 2. I believe this reminds you of the depreciation formula, but it's not the same, it's different, right? So initial investment plus the scrap value divided by 2. So let's do for ABC. For ABC, what's my initial investment? 2 million. What's my scrap value? 0 divided by 2, right? And we do the same thing for what? For XYZ. It's basically the same thing because the initial investment is the same. It doesn't change for this question in particular. Some questions it might have. Right. So that becomes what? 1 million here and 1 million there. Right. So that is the denominator and the numerator for your what? For your question. I see there are some messages there. Let's see if there's a question. Someone says, why do I divide by 2? You are dividing by 2 because you are finding the average between the initial investment and the scrap value. You are finding the average between the initial investment by the scrap value. But to make it simple for you, when you are calculating average investment, you always divide by 2. When you're calculating average investment, you always divide by 2. But the idea is you are trying to find the average between the initial investment and the scrap value. But you always divide by 2, right? And then someone says here, I am lost. Where did you get the profits for ABC? Please repeat. Unfortunately, it will take us a lot of time if we have to go back and repeat everything, guys. But remember what we did? I provided you guys this formula over here. We say the profit is equal to the net cash flow minus the depreciation. That's the profit. Net profit is equal to net cash flow minus the depreciation. And then I showed you guys the formula for the depreciation, and then I did the calculation for the depreciation, and then we did all of these calculations, which is basically 440 minus 400 is equal to 40,000. 560 minus 400 is equal to 160, and so forth. I am going to provide you guys the video after the lecture. If you miss something, you can also go back to it. But there is a formula for calculating net profit. Its net profit is equal to the net cash flow minus the depreciation. That's the formula of how I got the net profit. All right. So where were we? So we're done with this, right? So now we just plug into the formula. Remember? The formula is average annual profit over average investment. What is your average annual profit for ABC? It's 204. What is your average investment? 1 million, and that gives you 20.50%. And we do for the same for XYZ. What is your average profit? 200,000 divided by average investment, 1 million, and then we get 20%. So now we've got 20% ABC accounting rate of return, and 20.4%, and then for XYZ, 20%. And remember what I said, the higher the accounting rate of return, the better off the project is to the organization. The higher the accounting rate of return, the better off the project is with the organization. Right. So if you were to make a decision using the accounting rate of return, you would choose machine ABC because it is a higher accounting rate of return. That's the project that you would choose in this particular instance. Right. So we are done with this method. Any questions? Someone says, do they give us script value or it's always zero? They give you the script value. Some questions, it will be zero. There will be no script value. Some questions, there will be a script value. A script value is also known as a disposal value, in case you get confused in the exam and they say disposal value and they say, what is this now? A script value is also known as the disposal value. Basically, what it is, we are saying that if you sell the asset after you've used it, how much money do you get? So in this particular question, you got zero money. So that is why the script value is zero. All right. So let's go to the next method. So our next method is the, how much time? Do we still have time? Okay, 10 minutes. All right, let's do net present value. All right, so our next method is the net present value, right? So this one now, in terms of understanding what a net present value is, it's a little bit more complicated, but I'll try to explain it in simple terms so that you understand it. So think of it this way. I'm sure you guys you've done maybe some investments for yourself. You've put some money in the bank, right? Just to, for retirement purposes and all of those sort of things, right? So if I was to give you a choice, right? And I was to say, look, I can give you 1 million rand today, or I can give you 1 million rand in 20 years. Which one would you prefer? You would definitely say, James, I want the 1 million rand today, right? The reason why you would want the 1 million rand today is because you are trying to ensure that you what? I think there's someone who needs to shut off their camera. I'm not sure who it is. Okay. No, that's fine. I think it's done. Right. So the reason why you would choose the 1 million rand today is because it is more valuable than the 1 million rand in 20 years' time. Number one, just think about bread, right? I think 3 years from today, I think in 2021 or 2020, I remember buying bread for around 10 rand or 9 rand a loaf. But now it's around 18 rand, 20 rand, somewhere there, right? So you can see that the price of bread is increasing. So which means if I had 1 million rand, then I would have bought more bread than I would buy today with the same 1 million rand. So money loses value over time. So what managers realized is that when you are assessing whether a project is good or a project is bad, they wanted to give more emphasis or more value on projects that give you your money back fast than projects that give you your money back over a longer period of time. So they created this method called the net present value. So what this method does is it takes all of the money that you're going to receive in the future and it discounts them or reduces the value of that money in today's dollars. It's just asking you, if I was to give you all of this money today, how much would you accept? For example, if I say I want to give you 1 million rand in 20 years' time, and you say, no, I want it today. And then I say, if it's today, I'll give you 800,000. Will you accept that 800,000? That's what present value is. It's taking money that is going to be received in the future and discounting it to reduce it into the correct value in today's terms, taking into account the interest on investment, taking into account the inflation rate that money will be charged. Hopefully you understood that. But that's what net present value is, right? So the net present value method, in short, you are going to take every single cash flow. So this one also uses net cash flows, right? You're going to take every single cash flow that you're going to receive, and you are going to assign it a present value and say, this money that I am going to receive in 4 years' time, today it is worth this much. And how do you do that? You do that using what are called discount factors. They're in your study guide. They are called discount factors in your study guide. I don't think, do I have your study guide with me here? But anyway, We'll do that, right? So what you're going to see, all right, let me do this here. Sorry, guys, so that our learning experience can be a little bit more helpful. We have the answer already. I don't want to delete my answer, but I want to delete this that I'd already done so that you can see the actual steps. So you start off with a table, right? Copy. You start off with a table that is blank like this, right? And then what? You are going to say, I'm going to say, how many years am I going to invest in this project? So ABC is going to be 5 years. So I'm going to have year number 1, year number 2, year number 3, year number 4, year number 5. Then in each and every year, what is the cash flow that I am going to receive for this project? So, which is what? Which is 450 for year number 1, 560 for year number 2, 800 for year number 3, 820 for year number 4, 400 for year number, and so forth. You can see where I'm going with this, right? So those are the cash flows. Now, the next thing that you need to know is you need to get the discount factor. What is the discount factor for each and every one of these cash flows? Why do I need the discount factor? Because the present value is equals to the net cash flow multiplied by the discount factor. That's the present value. The net annual cash flow multiplied by the discount factor. So now I want to get the discount factor for you. Just give me a second. Do I have this here now? Accounting and financial management. Just want to get your study guide here. I hope I have it nearby. Yeah, there you go. All right. So if you check at the end of your study guide, there are tables there, right at the end of your study guide. I hope this is visible. Not really visible, but there are 2 tables there. There is table number 1 and table number 2. Table number 1, which says present value of R1, and then table number 2, which says present value of a regular annuity. So let's focus on table number 1. I will show you how to use table number 2, but for now we want to focus on table number 1. So table number 1 has got a list of all of the discount factors that you need for the exam. If you are doing this for your company, you can do this online. There are tables online that you can use where you get a lot of more information. But for your exam, this table contains everything that you need. All right. So what you do is you have to check for what is called the required rate of return. So there are certain words that they use. So discount factor is a function of the required rate of return, or in some textbooks, they will say cost of capital, and the period, or the number of years. So that's a discount factor. It's a function of those 2 things, the required rate of return and the cost of and the period, right? So in this particular case, we are told that the required rate of return is 15%. So what am I saying? I'm saying the ones that I need are under this column. Do you see that there are columns for 1%, columns for 2%, columns for 3%? So I want the ones under columns for 15%. So if I want the one for year 1, I go to the period number 1. If I want the one for year 2, I go to period number 2. So you can see over there, 15%, just trying to make it bigger, under period number 1, it's 0.8696. Do you see it there? 0.8696. That's 15% under period number 1. And then remember what we said? We said the present value is the net annual cash flow multiplied by the discount factor. So which means if I take this one over here and I multiply it by this one over here, and then I am going to get my answer of 382 something. Just forgive me here so that I'm trying to make it a little bit neat. So I'm going to get my answer there as my present value. Right. So that's how you calculate your present values. So that's what I did over here. I then went to year number 2. If you check there, 0.75, that's what I have here. Year number 3, if you check there, 0.65. Year number 4, if you check there, 0.57. So those are the discount factors. And then I multiplied the net annual cash flows and the discount factors for me to get the present values, which are these ones over here. Then once I am done with the present values, I add them all together. So the net present value or NPV is equals to the total present value minus the investment, right? So what is my total present value? I've added 382 plus 423 plus 526 plus 468 plus 198, and then I got 1,999,000. And then what is my investment? My investment is 2 million. So if I subtract that, then I get my NPV or my net present value of negative 204. Remember, I said if I put anything in bracket, it means it is negative. So that is why I have my answer there in brackets 204. So which means that we have negative 204 as my net present value. How do I interpret that? How do I interpret that net present value? So the interpretation is, if my net present value is positive, it means the project is going to add wealth to the company. The project will add wealth to the company, or let's say add profit. It's not profit that is adding, but we can use that word. It will add wealth to the shareholders of the organization. It will add profit to the shareholders of the organization. But if my net present value is negative, then I should have nothing to do with that project because I am losing money. So although we liked project ABC when we did the payback, although we liked project ABC when we did the accounting rate of return, we are going to reject project ABC because of the net present value, which is negative. You never invest in a project which has a net present value which is negative, because it means your organization has lost value. It has lost wealth. The investment was for nothing. Right. So with those words, I think for today, I am going to end my lecture here. But kindly, if you've got questions, please ask your questions before I just highlight from the beginning what I talked about. Are there any questions for me before I just make my... Right. If there are no questions, like I said, guys, my name is James from Varsity Unlimited Tutors. I'm going to be offering these tutorials to help you with your assignments, to help you with your exam preparation. So in front of me over here is a timetable. You can WhatsApp me, I can send it to you. It's a timetable. You can see this one is for the MBA students. It has got all of the different modules, right? You know, HRD, financial management, and etc. We have got the timetable for the postgraduate diploma in business management. We've got the timetable for the honors class. We've got the timetable for the project management class. So you've got different modules, different dates, and etc., where we are going to be doing this. So because we don't have a lot of time, the way that we assist you is we first focus on the assignments. That's where our first focus is. So just like we were doing today, is we meet on a particular day, we go through the assignment, I break down everything on that assignment. And then once we are done with the lesson, you then go and write your assignment. You already know what to do because we have broken down everything using the actual assignment question. So if your lecturer, you send me the assignment question that your lecturer has sent you, and then we break it down and highlight, okay, question number 1, this is what it is asking, this is what you need to do, these are the steps And then I do not give you the answer for you to just submit and say click and submit. No, you write it yourself. But we break it down. You ask questions. What about these gems? What about these gems? This one I don't understand, and etc. To make sure that you get your full marks on those on those questions, right? So you can see already that most of the lectures they're starting 23 January. So that's like on Thursday. So you need to talk to me by Thursday to make sure that you join those classes if you're interested. We have another free class tomorrow. For those that still want to finish this question that we're doing today. So we have another free class tomorrow to finish up this question. But the prizes, you can see them over there. It's 500 Rand for each assignment that you need assistance with. We go through the assignment with you. I'm not sending you the solution. We are going through the assignment with you so that you know how to do it yourself at the end of the day. Right. Then at the end of the semester, there will be an additional charge of 300 Rand if you want to join the exam preparation classes. However, other than the classes where we go through the assignment, I am going to send you at least 5 revision videos of the previous assignments, of the previous exams that I've done with other students that can help you to prepare for the exam. Right, questions? Someone says, how do I access the video? I'm going to send the video to you guys on your platform. Then you can also check it on our YouTube channel, Varsity Unlimited Tutors on YouTube. Varsity Unlimited, you can just subscribe so that you can get notifications. Varsity Unlimited Tutors on YouTube. But I will send the YouTube link of the video to your group, to the WhatsApp groups. I think maybe in an hour, I just need to upload it onto YouTube, just make sure that everything is in order. Another question? Is there another question for me? Okay, for the timetable, like I said, if you want the timetable, you are free to WhatsApp me. I think I'll just also post the timetable on the WhatsApp group. I'll also just post the timetable on the WhatsApp group so that you already know the dates. So the way these classes work also is you don't have to join everything. You might be very good at operations. You don't need it. You just join the one for the accounting one, the one that you need. All right, so that's the timetable for the honors, for the person that says, etc. Someone says, what about the answer sheet? Yes, I'll send it through. I had sent it on the chat here, but I will also send it through the WhatsApp platform. Anything else, guys, before we dismiss? Most of our lectures are 1 hour to 1 hour, 30 minutes long. Sometimes we go up to 2 hours, but not more than 2 hours, but usually 1 hour to 1 hour, 30 minutes long. That's the size of the lectures, so that at least you're still fresh in your mind. Anything else? If there's nothing else, thank you guys for coming through. I hope you enjoyed yourselves. Good night.
Bye.
Bye-bye.
Thank you. Bye.